Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals, celebrating our 25th year in business this year. Well, it's Friday, February 21st. I'm actually taping this in the morning as I'll be flying out to Las Vegas for the Liberty Mastermind Symposium, one of the best conferences out there. And I want to report on all the goings-on this week. As the title of this audio blog is China Dumping Treasuries, Food and Energy Soaring, and Wars Breaking Out Everywhere. So yes, lots of good news to report. I mean, basically, this is truly the end game, what's going on here. What we have written about all these years, what the good, smart people in our corner have written about is coming to pass. Just as it always does with fiat currency schemes. Only this time, the entire world is tethered to the Titanic, with nothing to save it. The inflation exported by the Fed worldwide is causing social unrest and government collapses around the world. It started with the Arab Spring in late 2010 as people in the MENA regions, that's the Middle East, North Africa, such as Egypt and Tunisia, spend the highest percentage of their incomes on food. But now it's spreading everywhere as the money printing exploded. It's no surprise that the first signs of this occurred about 2 years after the 2008 money printing explosion began, after the financial crisis. And now, about 2 years after the accelerated money printing schemes of late 2011, and remember, late 2011 is what I call global meltdown 2. That's when you had Europe falling apart and the US got downgraded and all that, and the stocks were getting hit around the world. And that's when they really increased the money printing. The US started with Operation Twist, which is really a backdoor QE, and then QE 3 and 4. You had the LTRO, the announcement of the OMT in Europe, and the Fed swap agreement in Europe, which was backstopping European banks with printed money. Abenomics in Japan, accelerated QE in the UK, and of course, ZIRP everywhere, as anyone who didn't have zero interest rates has since then taken them down to zero. And now we have threats of NIRP, or negative interest rates, in Europe. The average global currency since late 2011 is down 30% against the dollar, and 40% if you're talking about the Fragile Five, which is Turkey, Greece, Brazil, South Africa, and Indonesia. Not Greece, India. So that's all against the dollar because all the money printing. And in fact, just since the middle of last year, all these currencies, the average currency is down 5 to 10% against the dollar, which is quite amusing since the dollar index itself is sitting near its lows of the years, because remember, the dollar index is mostly measured against the euro. And believe it or not, the euro is actually up pretty sharply against the dollar. So while the rest of the world is plunging against the dollar because it's printed the money and exported the inflation, the dollar itself is falling as well. But of course, against other fiat currencies, it really matters not what any of these things are doing. What it matters is what the dollar and all the other currencies are doing against items of real value, like food and energy and, oh yeah, gold. We are seeing currency collapses morph into social and civil unrest, as well as actual borderline wars in places as diverse as Venezuela, Argentina, Thailand, Ukraine, Kazakhstan, Italy, where the government just fell apart, France, where it's on the verge of it, and Turkey. And this is all as we speak, and there's many others to come. We're actually seeing bank runs in some of these places, part and parcel with the breakdown of a currency, such as this morning I'm reading about in Ukraine. Universally, blame is starting to be cast on the United States, such as the comments from the Indian central bank recently, pretty ironic since they've played such a great part in destroying themselves. And of course, Venezuela, which just kicked out all of the U.S. diplomats and is blaming the U.S. for its problems. Remember, they're a major OPEC producer, which can cause significant issues with the energy prices here in the States, which of course we're starting to see. And now there's a growing rift with Saudi Arabia and some of the other former allies, or current allies, but lesser allies. So, you know, it's kind of, the walls are starting to slowly collapse around the United States. And then you throw in, again, this Ukrainian situation can't be underestimated of how serious it is. because as a result of it, in its strategic place in the world, the Russian ruble is right now, as I speak, at an all-time low against the dollar. I mean, lower than it was after the 1998 currency crisis when they essentially defaulted. So there's a lot of politics going on there, and you can be sure that Putin is not too happy about it. And you know, if we consider doing anything militarily there, which Obama has threatened, and it could, you know, devolve into something like Syria or worse. Now let's go to the economic data for the week. I think the two words that I've written down here are beyond horrible, and I'm not just talking about the states. First, we look at China. Their PMI manufacturing report is not only negative, but it's rapidly falling in negative territory. It was 49.6, remember, below 50 is recessionary. And then it just fell to 48.3 in January from 49.6 in December. So anyone who believes that they're growing at 7% their GDP is just delusional. They are contracting no matter what you say. And we look at their credit bubble where they had to, the PBOC had to bail out several of these trust companies this week alone. Remember, there's $23 trillion of debt in the Chinese system. It's not in the government. It's in the corporations and the local governments, which the federal government has kind of fostered and allowed them to get to this position, and now they're starting to default or get close to default. So I think that China is long past its growth stage. I think it's rapidly maturing, and as a result of its own problems and the rest of the problems in the world, I don't think you're going to see this engine of growth doing much for years to come. In Japan, which I call the land of the setting sun, I think that the odds of a hyperinflation starting there are probably greater than in any country, any first world country in the world. We're going to see them in other places. We're seeing them in places like Venezuela. But Japan, they had a 20% plunge in December manufacturing orders. They just reported a 0.25% GDP growth rate in the fourth quarter, following just 0.4% in the third quarter. And remember, they use a negative GDP deflator over there, even though they have the world's highest inflation. In fact, the government may say there's deflation, but even their CPI just hit a 5-year high last week. And remember, next month, they're raising the sales tax from 5% to 8%. And then to boot, next year, they're raising it to 10%. When they went from 3% to 5% back in 1996, they had a 2-year recession. And look where they are now with 300% debt to GDP, or 250 depending how you measure it. And the worst demographics in the world, and the Abenomics, where they're doubling the money supply. As I wrote a few weeks ago, the noose is tightening. And I can't even imagine how bad things are going to get in Japan and how draconian the response is going to be from the Bank of Japan in the next year. In Europe, where they love to say that they're recovering, they had a 0.3% GDP growth rate, they reported this week for the fourth quarter. And you know, when you see GDP growth rates like 0.3 and 0.2, that includes Japan also, clearly they're massaging the data to make it positive, but barely so. And of course, we have the record unemployment in Europe. It's sitting right up at the highs. Some countries are hit new highs this month, like Greece. Record youth unemployment, that's for sure. In places like Spain and Italy, an unexpected decline in the Eurozone PMI numbers yesterday. And in places like France, we're talking about 45 readings. I mean, way into contractionary territory. And then for the U.S., it wasn't even the top of my head. There was so much bad data this week, I had to actually look it up day by day. Remember, Tuesday, we started with the Empire State Manufacturing Index, which plunged from 12.5 last month to 4.5 this month. And then, on a normal week, this next piece of data would be considered the worst of the week, but in this week, it really wasn't. The NAHB, that's the National Housing Group, it's a private group. It's the Home Building Association. Their housing index fell from 56 last month to 46 this month, the biggest plunge ever. And believe it or not, the idiot economists had expectations that it would be flat at 56. And again, this is a propaganda group, NAHB, if you ever saw one. So everything they always say is overly optimistic. So if they say it went from 56 to 46, you can imagine how bad things are, which leads me to leads me to Wednesday morning's news that mortgage purchase applications were down another 5% for the week to a 19-year low. And then right after that, housing starts were down 11% in January compared to December. And for those that say that it was due to the weather, the biggest drops were in the West region where the weather was not a factor at all. And I could tell you because I live in the West and the weather has been amazing out here. We put a piece out I wrote maybe a week ago called Mother Nature Has Had Enough. And basically, it has nothing to do with the weather. The amount of flights and cancellations of flights this year and delays of flights is actually below normal. And on a global basis, the temperature has been above normal. November was the warmest month in history for the world. The problem is that since 2008, the number of flights is down 10%. The amount of of gasoline demand in this country is down 10%. The problem is there's just less people flying, not that the flights are delayed because of weather. I mean, has anyone noticed, by the way, that all of a sudden in the last few months, your gasoline station is writing cash price instead of the regular price, which is credit card, which is what most people pay? I mean, demand is down so much that people can't even imagine that gas station owners would be struggling right now because there's always an increase in demand, but not so. People are not driving right now, so they're actually putting the cash price, which is lower, to try to entice you to buy more gasoline. That's how bad things have gotten. Then we move on to Thursday. That's yesterday. The Philly Fed report was 9.4 last month. The expectation was that it would be +8. And know what it was? -6.3. A 15-point swing, one of the biggest misses ever. And of course, you throw in the earnings misses and the huge guidance drops, meaning the expectations going forward for Walmart, Marriott, International, all the hotels around the world, Caterpillar, and others. And Walmart is citing lower food stamps payments. They need the food stamps payments. And that's the one thing the government cut down. They cited healthcare costs. Can you say Obamacare? And weak retail in general. This is not good. Then the namesake of today's audio blog about China dumping treasuries is the TIC report. That's the Treasury International Capital Report. Now, I don't know how much they fudge this report. In fact, I think a lot of it they do, because they write things like that things called the Caribbean banking centers come in and buy treasuries and when we need them. And now, this last month, laughably, even though it was a massively negative number, they said that Belgium came in and bought a lot of treasuries. Belgium doesn't even have any money. Of course, that's where the head of the EU is. So clearly, we're talking about the EU is secretly printing money and buying treasuries to offset what the Chinese are selling, and that's the whole point. The Chinese the Chinese have stopped buying treasuries altogether. They stopped about 6 months ago, and then remember in November, the PBOC came out literally and said, it is no longer in China's interest to accumulate foreign currency reserves, meaning we are not buying treasuries anymore. End of story. And thus, it shouldn't surprise anyone that China sold 48 billion of treasuries in December, U.S. treasuries. That's the second most in 1 month ever. And they still have 1.2 trillion of them, as do Japan. And Japan is not a buyer either, I can assure you. Japan is just trying to fund the retirement of its aging population. And has no extra money to buy treasuries, so they're going to be selling as well. And hence the death knell of tapering, because there's no way on earth, especially in a weak economy, with the major owners of treasuries turned seller, that there's any way they can actually taper. And, anyone who's read my report from a few weeks ago called Proof of the Tapering Mirage, it's simple math. The Fed has been monetizing perhaps twice as much as what it says. And then you throw in stuff like the ECB, the magical buying out of Belgium, even though the ECB says that they are not buying anything right now. And you put two and two together. There's so much more monetization going on behind the scenes than is said. And why would anyone believe what these people are telling us anyway? I mean, heck, the COMEX still has a whole bunch of gold contracts outstanding from the December contract that haven't been delivered on yet, let alone February. This, I think, 300,000 or 400,000 ounces still standing for delivery. And what are they waiting for? It's like the German gold. What are you waiting for? Obviously, they don't have it. And by the way, in that death knell tapering article, as I turned the page here, I had the key was there was an actual chart there that's not just for China. It's showing that the pace of international selling of U.S. Treasuries has now exceeded that of the bottom in 2008, meaning that foreigners are selling U.S. securities, which would be stocks and bonds, so the PPT is needed as well, has exceeded the levels from the worst time of the past century, let's call it. I mean, we're almost up to the Great Depression when we talk about a century now. And therefore, yes, the Fed will continue to monetize, and at some point with the economy this bad, they're going to have to overtly turn around and say that they are no longer tapering. In fact, they're going to probably have to reverse it. And then we go back to what I said in the beginning about it doesn't matter what the dollar is doing against other currencies, it's what it's doing against real items of value. And just like people want to blame the weather for things, as if low sales because of the weather are not low sales, they're still low sales no matter how you slice them. People want to blame this drought in California, or for that matter, the one in Brazil, on high food prices and energy prices. The fact is, whether it matters not, the fact is we are having a drought in California, which the media is not talking about, which is the worst in 500 years. And remember, California is basically a desert. People were not made to live there by Mother Nature. It has beautiful weather, so they created all these irrigation systems, and they bring in water from out of state, and the Hoover Dam, Lake Mead, and all kinds of other, and as far as the Colorado River out here. But the fact is, they are subject to droughts that last for centuries, and this one may last centuries also. Right now, it's catastrophic economic impact. I mean, the Governor Brown of California called this an unprecedented emergency. He said it could cause them $11 billion of lost revenues. I'm not sure under what time period, but probably pretty short term. And this is a state which on its own has as much debt as all but 6 countries in the world. Big job losses. I put a vegetable chart. Everyone should read it in my report last week. It might have been the death knell report, but it's in one of them, and it shows the percentage of vegetables and fruits that are produced in California. It's simply amazing, because I had no idea. I thought, yeah, Florida, some other places. California produces a third or more of all of the fruits and vegetables in this country, and we're talking about 90% of lettuce, 90% of broccoli, 90% of strawberries, 35% of tomatoes. So we're talking about huge prices in the pipeline, price increases for the staples of life. And then you throw in what's going on in Brazil, which this may be an even worse drought. And that's why coffee prices are up about 80% in the last month alone. And they're rationing water to 150 cities out there. So, we've seen the biggest run up in the S&P Agricultural Index in 4 years in the past month. And then you throw in what's going on in the energy markets. Someone wants to explain to me how we're in a recession, but oil prices are surging. Gasoline prices in the United States alone have been at their highest level for this time of the year for the past 3 months, December, January, and February. So get ready for when we get to the summer driving season. Because if we have all-time high prices then for gasoline, we're talking about $5.50, $6 potentially in California, $5 in New York, and I mean, heck, it's already out here in Colorado, which is a low-cost state. We're already close to $3.50, and it's only February, and it's a recession, and it's been supposedly bad weather. Not to mention what's going on in natural gas prices. Remember, I was in oil analyst for many years. It's very rare to see natural gas prices this high, over $6 an MCF. And yes, we have had some cold weather in some parts of the country, but that's pretty high. And electricity prices are exploding as a result. So utility bills in some places are up 4 times as high as they were last year. And remember, at Miles Franklin, we put out our 2014 predictions article at the end of the year. And prediction number 4, which is the name of a piece I put out last week, was that no matter what happens with the economy, we're going to see much higher energy prices, and gasoline prices are going to, quote, march toward their all-time highs. And sure enough, look what's happening. Terrible economy, and yet the energy prices are surging. And then the other thing that we have been talking about for a long time is, of course, that that gold and silver prices have been hit so hard by the cartel in their efforts to desperately stave off the end game that they've pushed the prices below the cost of production. And again, I believe, based on what the CEO of Goldfield said a few months ago, that gold has to be $1,500 an ounce and silver has to be $30 an ounce, or else not only are these companies not going to make money, but they're not going to be able to grow reserves over time. And believe me, it's getting more difficult out there, not just to produce oil, but to produce gold and all kinds of things. It's just all the low-hanging fruit is gone. And now that governments are taking these big royalties, I mean, heck, people trying to poo-poo, Mexico just added a 7.5% royalty tax on gold miners. And these gold miners have no money and aren't making money in the first place, and they're adding it. Just wait until gold comes back in fashion and governments think of it as money. They'll just windfall tax everything they can if they don't take it outright. And I mean, you look at, I predicted massive write-downs because, again, every year at this time, at the end of the year, the mining companies redo their reserves. They say, okay, let's pick a gold price and let's look at our reserves and see if they're still viable. Well, the write-downs were so much worse than expected. Even I was floored. Remember, Barrick Gold. I wrote a piece called Evil Personified last year, which describes my views of them. They are the #1 miner in the world by reserves and production by a lot. They reduced their reserves. It was expected that they were going to reduce their reserves by about 10%. They cut them by 26%. Not only that, their production in 2013 was down to a 9-year low, and now they're forecasting a 10 to 15% drop in 2014 production. And remember, they wrote off Pascua-Lama, their biggest potential growth area. They had to do all these emergency deals just to save themselves. They're cutting capex by 50%, which is the industry norm, and they reported a $10 billion loss. That's just Barrick. Kinross, which is the #7 producer, they wrote down the reserves by 35%, yet they were using $1,200 gold. I mean, Barrick wrote theirs down. They had $1,500 gold last year and reduced it to $1,100. So some of the reserve decline was simply because they're uneconomically lower price. Kinross was using $1,200 last year and $1,200 this year. So they reduced their reserves simply because they were low quality reserves. They just looked at them and said, why do we think these were good? These were viable, $1,200. They're not. And then, of course, last night you had Newmont. Kinross, by the way, is expecting flat production this year. And then you had Newmont last night, which reported 11% reserve write-down. And they are expecting production to fall 5 to 10% next year. Comically, in their press release, they say, whoa, we expect it to go up to 4.8 to 5.2 in 2 years from now. But it's 4.9 now. It's 5.1 now. How is 5.1 going to 4.8 to 5.2 up? You talk about propaganda. There is no growth in the mining companies. Barrick is #1 in the world, and Newmont's #2, and they're both going down. And then, of course, you had the FOMC meeting on Wednesday. I predicted it Wednesday morning. I said it's a key cartel attack event, that they would attack gold and silver prices the second it came out, and of course they did. Look, they don't say anything new at these meetings. They said absolutely, utterly nothing. But the beauty of it is that the prices came rocketing back on Thursday, and here we are Friday morning, and gold's back up to $13.23, and silver is knocking on the door of $22. Their best efforts are kind of, being quashed right now. In other words, it's becoming quite clear that the damage that was done last year was probably the bottom. And therefore, at any time, anything could happen on the upside, especially with the thin inventories around the world. And remember, China just announced, well, they didn't announce, but the numbers came out and showed that they had more imports in January of gold than in any month ever. And last year was their best year ever, twice as much as 2012, which was the previous best year. And by the way, with the FOMC, people just got to keep watching those stocks around the world. It is amazing to me. I said a while ago, there's just as much a chance that we'll hyperinflate the stock markets as a crash, and either way you're going to lose, because the nominal gains quickly become, or the real gains quickly become nominal gains. I mean, all you have to do is look at places like Venezuela, Argentina, and South Africa. to see that they're record high stock prices as the countries are collapsing. And I think a bit of what's going on here is the same. Yes, it's partly the PPT and the Fed free money, but I think you're starting to see some of that. So don't be surprised if you see markets soar, while at the same time those energy prices and food prices soar faster. And of course, gold prices. By the way, Bitcoin, I wrote a piece last week called Store of Value, and I've said all along about Bitcoin that the platform is interesting, and that there may be some interest worldwide in an alternative currency, that's practical, that gets outside of the government system. I also said that government regulations, and central banks would attack it in every possible manner. But what you've seen this week is them attacking themselves. The fact is, these are unregulated, and Mt. Gox, MTGOX in Tokyo, has been the #1 exchange for years. And it's on the verge of collapse right now. The price is now trading at an 80% discount to the other Bitcoin exchanges, which themselves are down 50% just in the last few months, because you can't withdraw your coins, and no one knows why, and the company hasn't given guidance. So the fact is, anyone who thought that you were preserving your wealth by hiding in Bitcoin has already found out, after just not even a year of excitement, that these things, while they may have some upside over in time, are not stores of value. Not to mention, they require computer systems to be up. The grid can't be taken down. All these things, which if you hold physical gold and silver, you never have to worry about. Anyway, to conclude, as I wrote on Monday in my piece, the realization of reality is finally upon us. Thus, I would expect anything to occur at any time this year, including, of course, potentially a major default in the ultra-tight physical market. Who knows where it'll come from? The Germans, the COMEX, the Shanghai Exchange, who knows? But we're talking about record demand for gold and silver. We're talking about solidly negative forward rates, which should never happen, and only happens if the paper price has been, is way below where it should be. Razor thin inventories, and of course the strongest fundamentals probably in our lifetimes, maybe in several lifetimes. Something's got to give, and the PMs are clearly starting to turn the tide against the cartels. So again, anything could happen this year. Who knows? And if something big enough happens, don't be surprised if supply dries up. We've seen it dry up when nothing was happening, like last January, like last April, like in 2011, like in 2008. And if it's the big one this time around, you're going to lose your chance, possibly forever, to protect yourself from hyperinflation. Incidentally, as I said, Miles Franklin's kicking off its 25th anniversary celebration this coming week. As always, it's an honor to serve you, and if you're considering a precious metals buy, sell, or trade, not to mention our amazing Canadian storage program, give us a call at 800-822-8080 and give us a chance to earn your business. Thanks very much, and have a good weekend.